there's some value to a national brand like a Kitty Academy, even though the franchisee may be new or only has 1 or 2 locations. It's still better than, Joe's Childcare, on the corner.
First of all, if you're sending your kid to Joe's Childcare on the corner, stop.
Yeah, stop right now.
Welcome back to How to Invest in Commercial Real Estate, guys. It has been a busy couple weeks for us. We've been slinging deals. We're about to break ground on a deal here in Owasso in August. We're about to close on a deal in Vegas here in a couple weeks. I know you got a deal you have going on right now.
Yeah, we're just finishing up an equity raise on a multi-tenant retail deal in a fast-growing county of St. Louis, Missouri. Okay. We're about 85% funded on that.
Pretty cool. Anyway, there's a lot going on. So, just if you would have been on our 2 investor email list, you probably would have gotten hit with 3, 4, 5 investment opportunities over the past month.
Yeah, so sign
just
up,
a reminder.
PrecisionEquity.com, the CriterionFund.com.
Absolutely, super easy. You type in an email, name, boom, all the investment opportunities you want to your email. Anyway, today is all about the different types of guarantees or structures on commercial lease. So, when you buy a commercial building, it's typically occupied by a tenant, several tenants. They've got a lease, and you need to understand the financial weight behind that lease, because that lease is really the only thing that you have to rely on, that you're going to get paid month over month, and hopefully have a profitable commercial real estate venture. And you need to kind of dig in and do some due diligence on the tenant, and looking into the different types of credit they have or their lease structure is the best place to start.
Yeah, we typically put them in 3 categories. You've got a national credit tenant, which is going to be Walmart, it's going to be Starbucks, Walgreens, Home Depot. These groups typically are publicly traded. They typically have hundreds, if not thousands, of locations.
Right.
We've got regional credit tenants, which could be anything from we have a regional credit tenant in our Memphis deal. It's a private equity group. It owns 600 Planet Fitnesses across the country. So they're not a publicly traded group, but they are really strong financially, and they've got a bunch of locations kind of spreading out their risk.
Right.
And then you've got what we call local tenants, or mom and pop is a term we use in the business, where they may have a nail salon, they may have a donut shop, maybe a restaurant of some kind, or they're selling their knickknacks, and they just have that one location. And the strength of that lease is just on their guarantee and their financials. So that's kind of the broad categories that we can discuss today.
Yeah, so let's start at the top. Let's go back to national tenants. Let's say somebody wants to buy a Chick-fil-A. That would maybe be pretty appetizing. You would think, man, Chick-fil-A is always going to pay their rent. They're never going to default. Man, they're so busy. They've got lines out the tail. If I want to own a piece of commercial real estate, I want to own a Chick-fil-A. That seems pretty safe, right? Mm-hmm. Why can you not own a Chick-fil-A?
Well, you can. You can own a Chick-fil-A. I think
you just don't make any money.
Well, there's pros and cons to each of these tenants, and so it all depends on what your goals are, and that'll help you decide which tenants you're going to go after.
That's a great point.
Yeah. So Chick-fil-A, you're going to get typically a longer lease. You've got a great, strong company so you can really just kind of forget about that tenant.
So it's more of a preservation of capital. Like, hey, I don't want to lose my money.
Yeah, you're not going to lose your money, at least in the short term. You're not going to lose any money. And in fact, they're going to make sure they pay you every month. So it's just stress-free ownership of commercial real estate. That would be a positive. The negatives are, the cap rate that you're going to buy at is going to be really aggressive.
Right.
If you don't have substantial bumps in the lease, the future growth of the value of that property is limited.
Right.
Even though guaranteed or semi-guaranteed, it's limited in how much the value of that property can increase. Your cash flow is going to be lower. The returns are going to be lower in the near term because of the cap rate you're buying it on. So you're trading security for lower returns. You're trading optimal location for returns, all kind of geared around safety and security versus a higher risk return profile.
And that's because they're more of a sophisticated buyer also, right? Aren't they going to negotiate a little harder? They've got probably a whole group dedicated to negotiating leases, right? And so as opposed to maybe a couple of these others on the lower tier, they're very sophisticated, and they're gonna negotiate pretty hard, aren't they?
Yes, and example of that, I was negotiating with Ross, $1 billion group, for their DD's concept in one of our locations.
Right.
And, so the positive in getting them is that I'm going to get a 10-year lease and the center with a national credit tenant on a 10-year lease.
Yeah.
I'm going to be able to sell that at a lower cap rate.
Yeah.
So that's really, really positive.
Fun facts, no one share though. Ross doesn't pay anything in
Yeah,
rents.
they are a very good lease negotiator to the point of absurdum. And so what we ran into is not only do they not want to pay a lot of rent today, but they also want 5-year options, 10 5-year options with minimal increases.
Right.
So they've literally locked in your upside.
So they think, well, we're so big and we're such a great credit risk that they can negotiate a better deal, right?
That's exactly right. And so we ended up ultimately not doing the deal with them because we were able to get a lot higher rent from someone else that was still had some credit.
Yeah.
But those are the pros and cons of working with these national tenants is that they are going to be really tough negotiators. And, they're going to negotiate things in that lease to obligate the landlord to a bunch of different risks that you don't have with a mom and pop. You can kind of steer the discussion with a mom and pop and put the risk on them, where the national credit tenants are going to put a future risk of, CapEx expenses or roof repairs or whatever on you.
So, and another advantage is even if that location, let's say you have a property in that particular location for this big national tenant is not doing well, they've got the backing of their home office to make sure that they pay that rent, right?
Yeah. Go ahead.
Yeah, a lot of the times, and you can just, they're publicly traded companies, so you can just look up the financial stability of these companies. Ross, you can just go look how they're doing, how they're performing, how their shareholders feel, what their board is doing. We bought a center with a GameStop in it. Yeah. We assumed that GameStop was going to be vacant because GameStop stock went from an all-time high down to nothing.
Yeah.
Who's buying video games in the store anymore? Anyway, it's just you can look at that kind of stuff and it helps you make assumptions because you're going to go in, you're going to say, am I going to keep this tenant? Am I going to lose this tenant? Am I going to be able to replace that rent? Am I going to be able to backfill this space? And you've got to be able to plausibly say, I've asked that question, because when GameStop leaves and your investors come to you and say, hey, why did GameStop leave? And you're like, man, I have no idea. I thought they were doing great. But then they're a publicly traded company and they weren't doing great. You're in a world of hurt. You should have been able to find that information, right?
Yeah. So let's go down to the next level. Regional, you talked about. Is there any difference between regional and these big national chains, really?
Yeah, I think there is a difference. A regional could be, like I said, 10 locations, 50 locations.
Typically not public yet.
Not public. So they're just going to be perceived as slightly more risky, slightly less guaranteed than a national credit tenant.
Right.
Because the national credit tenant, things go up and down, but as long as you're checking their financials, that it's thought that, well, they have so many locations, they can absorb some downturns and still be in it for the long term.
Right. Same with franchises could be considered regional credit. You have, T-Mobile. T-Mobile may have, tens of thousands of corporate stores, but they have 10 times more franchise stores. So you may have a regional operator of T-Mobile stores where, like you said, with the Planet Fitness or whatever.
Well, some franchisees, they may franchise, I don't know, maybe Subway or something, and they've got 30 Subway locations.
Right.
Their experience, their financials are going to be stronger.
Right.
And so they're going to be a better tenant, long term. Once again, it's all relative, but that's the next tier.
On that deal, does the corporate office back it because it's a franchise or not?
Typically, I would say no. You're going to get that franchisee's credit.
Okay.
So if they have one location, they're obviously going to provide more risk versus someone that has 30 proven operating locations.
Right. Okay, that makes sense.
Yeah, I would say the same thing for our Kitty Academy. You have a national brand, but you have kind of a regional or a local operator. And you need to know either way. You need to know where your recourse is, whether that's on the tenant or on the operator, or on the franchisee. And you need to just go down and ask questions along the way of how each person at each different level could help you, maybe at recourse or at least negotiation or acquiring debt or whatever.
Right.
And there's some value to a national brand like a Kitty Academy. Even though the franchisee may be new or only has 1 or 2 locations, it's still better than, Joe's Childcare, on the corner.
First of all, if you're sending your kid to Joe's Childcare on the corner, stop.
Yeah, stop right now. But it's a national tenant, so that means when parents are looking up where to send their kids, you have a brand at your location. It's going to be safer and better to have that versus
National
just
standards.
a mom and pop.
Yeah.
Right. Yeah. So, as we kind of move from regional to local, local could be where the money's made. A lot of people can get scared of local tenants. A lot of bigger corporations, maybe on the coast, or a lot more sophisticated buyers. And local tenants, I've found that more often than not, the owners of those centers are probably local themselves, because they're the ones that can truly appreciate the stability that they would bring. If you've got a local pizza restaurant that is slammed every night of the week, but it's their only location, you should still feel some comfort knowing, hey, this pizza joint is slammed. Maybe talk to the owner. Hey, are you doing great? How's sales? Maybe you lose them because they're doing too good and they need a bigger space. But I mean, there's still that in-person element, and a lot of the times there could be some value. We had a center in contract with a regional gym tenant, and we wanted to buy it, and the gym tenant defaulted in the middle of COVID, and it was kind of upset. And we told the seller, hey man, if you get it re-tenanted, we'd like to buy it. You have a nice center, whatever. They come back with what they think is this tiny local tenant, a pretty undesirable tenant, a church at that. If I'm going out of my market and I find a local church tenant, I'm typically pretty hesitant because they could be fairly risky. I don't know anything about the church or the local aspect of it. A lot of churches are bet on like one person. If that one person goes south, the whole church is south. Anyway, churches are kind of not the most ideal when you're looking at buying a shopping center. Anyway, this seller says they get a local church on the move is going to occupy our center. And we were just like, shh.
Yeah, they're pretty strong.
They're pretty strong. They're pretty strong. They've got the strength of national brands, but they're 100% a local tenant. And there can be a lot of comfort in that just by you digging in and knowing, the credit of them, even though it's not publicly accessible.
Well, so I want to talk about some of the positives of looking at deals with mom and pops, because obviously that's kind of what we own. Yeah. And, I would say that there's going to be less competition for centers like this just off the bat. Is you have national credit tenants. Not only are the rents going to be lower and the cap rates and the returns going to be lower because you don't have as much risk, but there's less competition for these deals.
Yep.
And so for me, that's a big plus. Another one is local tenants. You typically are able to negotiate way more favorable lease terms, and they're going to be shorter leases. And you may say, well, Joel, why do I want a short lease, like a 3-year lease? Well, it depends. If you're buying a center that is lower than market rate on your rent, then the ability to increase that rent comes at the lease renewal.
Right.
So if you have a 10-year lease, a 15-year lease, you don't get to change the income substantially. You may be guaranteed to get that income, but for us, we're value add guys. And so for me, that's been a big positive for us is like on our Village South Center, we walked into rents at $10 a foot and we're renewing them at 14, at 15.
Wow. Nice.
And so that's 40% increase in bottom line NOI. Because that's what the market could bear. But a national credit tenant, for one, they're going to be on a longer lease, but two, they're going to be cutthroat on their negotiation. They're never going to accept a 30% increase in rent.
Yeah. If they would, they'd move across the street and get a developer to build them a brand new building.
Yeah.
I would think it would be easier to negotiate a shorter lease with a local firm because they're not exactly sure what the future holds, right? They may grow, they may shrink, and they want a shorter lease probably, right? They're willing to pay a little bit more with a shorter lease, hoping that they grow, and next time maybe they say, okay, well, maybe we can negotiate a longer lease.
Yeah, they pay more for the flexibility.
Yeah,
in a sense,
exactly.
they should pay more for the flexibility to get out of it.
Yeah.
Right.
But once again, if we're buying at the right level, price per foot and rent per foot in the market, then we're not worried about losing a mom and pop tenant at $10 because we know that that's a competitive rate. We can backfill.
It's just 100% downside protection.
That's right. And so, what I'll say, just for people listening, is there's something to be said for high quality real estate. And I'm all for people that can afford that want those returns. And if you get in the right market, the appreciation in a high growth market could very well be a huge return.
You're talking about the Chick-fil-A, the Starbucks on the busiest corner in town?
Yeah, something like that. If you can get in and inflation and that growth in there helps you, awesome. But for me, what we've had success in doing is whenever there's uncertainty, whenever there's risk, there's opportunity. And so I want people to hear that is that the more you're not going to be able to be super competitive with the national credit tenants and the huge properties and the best locations at first. And so this is why we kind of preach these style of units, is because we can evaluate the mom and pops, and yes, it's messier, and yes, you've got a little risk and a little turnover and things to worry about, but the return is in those numbers if you buy it right.
Yeah, I agree.
If someone on the local level comes to you and do you have them give their financials, and if their financials are low, do you ever turn them down on a lease, or
That's
do
a
you
good
just
question.
100%. It's just like renting an apartment, in my opinion. If you go rent an apartment, you're going to fill out an application, you're going to have a job stub, and they're going to say you need to make 2.5 times the rent or whatever, maybe 3 times, depending on where you live, maybe 4 times. It's going to be similar in commercial. You're going to fill out an application with a manager. You're going to say, what's my net worth? What's my balance sheet? Here's my financial statement. Depending on how sophisticated you are, you may not have to submit that. You know what I mean? Your weight may speak for itself, and they may not want to show all their cards before they start negotiating. But
For me, though, I'll say this. Let's say I have a vacant parcel or whatever that someone comes to me and they want to rent and they don't have good financials.
yeah,
Well, if they say, hey, we don't want any tenant improvement dollars, we're going to sign this lease, and 30 days later, we're going to start paying you, and we'll build out the space the way we want it.
done.
I'm going to let them.
Yeah.
Because it doesn't cost me anything, and I've had a hard time leasing that space.
Oh, right.
And so for me, it's just like, let them go to town, and if they're successful, we both win.
Right.
If they're not, well, I didn't give them a bunch of money.
Yeah, you're the big blind, and it's free to see the flock for sure.
But if it's flipped, if they come and they say, hey, we have this new pizza concept, and
Well, this just happened
and
in-
we
in
want
COVID.
$100,000 to build out our space, and by the way, our financials suck. Well, why am I going to spend $100,000 building out a pizza joint for these people that don't have any money and have not done this before?
Yeah.
To me, that's riskier. So yeah, then I'm going to probably turn them down. It's too big a risk up front for me.
Yeah, and I mean, I feel like we literally just chose this. I mean, you were picking between a couple tenants on a restaurant deal, and one was maybe less rent, one was maybe higher rent, but the less rent paid today. Hey, we're willing to take the risk. We know this concept's going to work. We may not be the highest paying rent, but we're going to start today, and we believe in it. Versus the next guy is like, hey, I'll pay you a ton of money if this works, but I need 6, 7, 8 months for free to see if that works.
It's tough.
Yeah.
And the risk is on you. So, I'm not saying there's a right or wrong decision there. You may end up better one way, but, money day one and putting the risk on them is sometimes the best decision.
Yeah.
Anyway, I hope we enlightened you. The ability to go and read the lease and understand the guarantee structure and understand, where the credit is coming from, where your recourse is, how that helps you with acquiring properties or acquiring the debt, or just how you look at deals and where you want to buy them.
Yeah, obviously there's a lot more discussion to be had on this, but it was just an intro to say, hey, be looking at what kind of credit tenants you have and what are the pros and cons for each tier of tenant, national, regional, and local. And understanding those will help you, increase your potential to be profitable.
Absolutely. Anyway, thanks, guys. We will catch you next time.
Okay.
Thanks.